Hey everybody, it's Andre Bagansky from Decrypt coming to you today with an interview with none other than Arthur Hayes, BitMEX founder and Maelstrom CIO. How are you doing?
I'm excellent. It's a great day to be in Vegas.
Are you a fan of gambling, by the way?
I don't gamble myself because I like my money, but I have no problem with it.
Okay, it's one of those things where it's like, I'm hoping to see a Bitcoin-powered slot machine at some point, but I just don't think the industry's there yet. Diving right into it. In your latest essay, which everyone should read, honestly, come on, guys, you say that capital controls, not tariffs, could be this administration's answer to restoring American manufacturing. Essentially, a tax on foreign governments' holdings of U.S. assets like stocks, bonds, and real estate could keep their capital accounts in check while also driving them towards non-sovereign assets like Bitcoin and gold. That's a lot. Can you essentially give the TLDR on your latest essay?
So essentially, I look at the chart of the U.S. current account deficit, trade account deficit versus the capital account surplus, and they're mirror images of each other. So you can either attack one or the other. You can either tariff goods, the price goes up, people buy less stuff, or you can tax capital and make it not as welcoming for people to park their excess savings in the United States capital markets. Now, obviously, the Trump administration has tried and is trying tariffs, and I think they're very quickly waking up to the fact that it's very politically unpalatable to have goods inflation or empty shelves or small businesses who cannot, make their business work if things are 50, 60, 70% more expensive. And so I think that obviously they've walked down the severity of tariffs. We have these 90-day pauses, and I predict that those 90-day pauses are going to be pretty much permanent, and there's going to be very cosmetic changes to the underlying rate of goods tariffs in the United States. But again, the goal still is, how do you rectify these imbalances? Well, then go after the capital account, because I believe it's more politically popular to blame foreigners and to tax them and take that money and maybe do some sort of wealth transfer, whether it's a tax cut or it's some sort of government handout, and that's a way to sort of make the population feel great about sort of rectifying these imbalances. And so if capital controls happen, then foreigners are going to be less likely to want to own stocks, bonds, and real estate. And I posted some charts in my essay that basically showed that foreign demand for U.S. assets was what created this U.S. exceptionalism over the past almost 3 decades, since the early 2000s until the present. And so if we take that capital away, then what are the authorities going to have to do to make sure the American capital markets don't collapse? And obviously that means printing money, and crypto and Bitcoin benefit from that.
Yeah, and drawing that tie-in towards how capital controls could encourage sovereigns to buy gold and Bitcoin, could you just make that distinction a little clear?
Sure. So obviously what happens is a foreign central bank creates domestic currency and accumulates dollars when the people who are selling goods abroad have to bring that money back on shore to pay their domestic expenses. So the state accumulates all of these dollars. The only place it can put them is in the American capital markets. It's the deepest, it's the most liquid, it's got the most variety of things. And because they've created so much credit onshore, the rates of return in their own economy are very low. Consumer spending is lower than it should be because these currency manipulations are a tax on consumers and a subsidy for producers. And so the domestic economy isn't great. No one wants to invest, so they want to invest abroad in the United States because this is the place that's being stimulated with global credit. And so that's why all these central banks and then obviously corporates are essentially short the domestic currency and long US dollar assets. But if the rate of return changes where you get some sort of tax on capital gains, or maybe there's a user fee, or there's all sorts of different ways in which they can do this, then that differential narrows, and all of a sudden it doesn't make sense anymore to buy that US Treasury bond or to buy that apartment or to buy big US tech. Maybe they should bring the money back onshore, let their currency appreciate, and buy assets within their own economy. And as this unwinds, you're going to see capital sucked out of the U.S., and there's not going to be buyers for treasuries or stocks. And on the margin, that causes prices to fall.
You talk about the 90-day tariffs as something that will become more permanent, right? I'm wondering if you have any thoughts on some of these tariff announcements that we've seen in terms of the EU and Apple, where it's we're still seeing some of that rhetoric. Obviously, I believe Trump pushed it out to July 1st when it comes to those EU tariffs, but still using that a little bit in terms of trying to move markets a little bit, it seems, or at least change the dynamic there.
Well, I think at the end of the day, Trump wants to proclaimed that he declared victory over tariffs. And so, yes, there's been a 90-day pause, but he's still in negotiating posture. So he's going to turn up the heat and the rhetoric, like with the EU, the tariff thing, and then they back down again.
Yes.
So I think we're going to see a similar thing with a lot of other countries, and especially China in August. They're going to ramp up the rhetoric again. They're going to go hard at China. Maybe the markets sell off a bit, and then all of a sudden it's, now we found a deal, whatever that is, and the status quo is going to be extended.
Interesting. And you say that Bitcoin is going to hit $1 million by 2028. Where do we go this year?
So I think that we go to 250,000 by the end of the year.
Why?
So the money printing is going to continue. I think it's going to accelerate into the fall. Midterm elections are coming up in the U.S. And so while the Trump administration went hard on tariffs and was taking this market pain for the last sort of 3 months, that has to shift. So now that people in Trump's orbit have to get reelected in 2026, and the Republicans as a party need to show that they have, brought goodies to the population. And so I think that means that they're going to accelerate the money printing. And we saw Scott Bessent doing a bit of foreshadowing of what's going to happen. They talked about Fannie and Freddie, the mortgage companies, being allowed to raise capital again and lever up their balance sheets to contribute liquidity to the housing market. They're talking about a supplemental leverage ratio exemption for U.S. Treasuries that allows the U.S. banking system to apply infinite leverage to buy Treasury bonds, which is obviously very positive for global capital markets. And I think we're starting to see different academics come out with papers saying, hey, it wouldn't be so bad if the U.S. taxed foreign capital. Here's how much revenue they could receive. Here's a way in which they could do it to incentivize foreigners to sell short-end bonds and buy long-end bonds. And so different papers are coming out. So we're starting to see the academic sort of buttressing this, we're going to do capital control. It's going to be very slow, but we're starting to see signs that that's going to happen.
Now, I think I heard you just say that money printing will accelerate into the fall. Do you believe the money printers have turned on yet? And if not, when?
I think there's always been money printing. The question is the pace of it, and what does the market expect? Obviously, come before Trump was inaugurated, everyone's expecting this massive economic boom, lots of credit created. Obviously, that turned out not to be the case with these tariffs that were implemented, at least the starting block in April 2nd. But again, we got ahead of ourselves in terms of what we expected. The reality was different, and obviously the market corrected.
You're an OG as far as crypto goes, and I think one of the things that I wanted to ask you about is whether or not we can rely on some of these mythos sort of trends from previous cycles. I think one of the biggest ones is the rotation out of Bitcoin after its dominance peaks. And, we've got ETFs now that were approved last year. Obviously, the people who are buying these ETFs can't easily just swap for ETH on chain like maybe the sort of history of that trend has gone. Where do you see Bitcoin's dominance going this year in terms of its percent of the overall crypto market?
I think Bitcoin dominance maybe might peak at 70%. I think it's about 65% now, and then it'll come down. Will it go down as far as 20 or 30% as it was in 2021? I don't think so. I think that the market's got a lot more discerning on the types of projects that they're going to reward with their capital. And that means that if you have a project with no customers, that don't pay any money, and you don't give any money back to the token holders, I think those older projects are not going to do very well. So the days in which the dust in your portfolio went up 10x during the altcoin bull run, I think that's over. There's going to be very concentrated winners in this altcoin cycle, and obviously there'll be a new narrative, new shitcoin that we all love to trade. I don't know what that's going to be, but that's how I think it's going to happen in this altcoin shitcoin season.
Sure. I know we're at a Bitcoin conference, but I got to ask you real quickly about ETH. Is 2,600 a fair price for that asset, and where do you see it going this year as well?
So I think ETH could go to 4,000 to 5,000 this year. I think it's the most hated layer one, and usually you want to be in the most hated asset in a turn in the cycle. So I think ETH could outperform.
I love that.